Recording in progress.
All right, good morning, everybody. So we made it through the CPI and the PPI. Looking at the probabilities within the rate cycle, we now have a 98% chance that there's going to be a 75 basis point rate hike, but you will notice that there is a new bar here. The new bar is 100 basis point rate hike. Now, they haven't really started kind of moving in that direction. There's no real push for that yet, but considering how the numbers came out yesterday, really implying that all of this pain and all of this damage and destruction that the Fed has been doing hasn't accomplished anything yet. Kind of implies that they may want to step up and do a little bit more. So far, there's nothing to support this, right? So at the moment, it's just a minor change. The reason I point it out is if they do begin to price in a 100 basis point rate hike, it's another 25 basis points we're going to have another leg down. So if you look at the Decembers, suppose we go from 3 to 375 in November. When we look at Decembers, we're talking at this point going from 375 to 425. That would be a 50 basis point rate hike, but the one that stands out is going from 375 to 4.5 or 450. That would be a 75 basis point rate hike. So that's 275s back to back. That would get us into the end of the year at 450. And 450 is generally speaking where the rate cycle tends to stop. They don't generally raise beyond that. Now, I'm not saying they never have. Obviously, they have. But if you look back historically at how many cycles we've gone through and where the cycle usually topped out, it has usually topped out at about 4.5% or 4.5. Right? So we're going to be getting there by the end of December if we get back-to-back 75s. And the rate of change, right, how fast we got to 4.5 is a little bit historic. Right? It's not like we've never been here before, but how fast we got here is a little bit record-setting, and it's still not accomplishing their task. It shows that they have so much more work to do. So any discussion about the bottom is in and we're headed back to the highs and it's time to buy, that's crap. Don't even start believing anything that you see out there suggesting that you should start buying now, because we are not done, and there is very likely more downside before we ever come out of this. Right? We're talking years before things turn around. So keep your eye on the December 14. There's no 100 here yet, and if you kind of game it out, considering how bad everything was, they need a little bit of time to kind of mull that over and let the news cycles do their thing and start asking them, hey, are you willing to go to 100? And that's what it'll start the conversation. They'll start bringing it up. They'll talk about it more. It might be too late for them to actually squeeze it into November without shock and awe, right? And that might not be their intention, but they could get it into December. So we want to look for the bar to pop up that would say 475 5.0. That's what it would be labeled as down here. And then we have the Feb 1. And at this point, they're just starting a new column. Remember, and we talked about this the other day where I said look to the right and look for a new column to start. If they start pricing this column in, then we're talking about going from where we are now at a 3 to being up to a 525 within 3 cycles, or within 3 rate hikes. Wow. Yeah, banks do kick off earnings season today. JP Morgan, Wells Fargo, Citigroup, Morgan Stanley. Yesterday it was kind of interesting. We're going to take a look at tech and finance and how they were performing yesterday. Oh, somebody got fired. Oh, bye-bye. As if everything going on over in the UK wasn't bad enough. Change is volatility in the marketplace. When you've got an embedded government official that's been there for years and years and years who loses their job, and then they start going through they replace that person, then they start replacing people within the cabinet, then they, it's goodness knows how far it's going to go. This chancellor, I'm not even going to try to pronounce that last name, was a part of the whole pension fund debacle anyways. So right, nothing really big stands out news-wise. And they were kind of fine there. Manufacturing and retail sales, I mean, it's important, but it's not, market shattering and in relation to, say, like an FOMC would be, or a PPI or a CPI or something like that. All right, so this was the NY Fang yesterday until around, like, say, 10:30 or so. And this was banking yesterday up until around 10:30 or so. So banking opened and moved to the upside. And while it wasn't really, like crazy bullish, finance was doing really good yesterday, right from the get-go, straight off the deck, right? Bell rang, it moved up. Held above VWAP, kind of stabilized, everything was doing fine. Technology, on the other hand, the monsters of tech, had that significant beatdown and then was trying to rally back up, right? Like a little bit of a mean reversion, just getting back to the starting point. So a really different morning between the two of those two yesterday. And when we finally got tech into the game and started working with finance, I mean, that was the real catalyst, right? The real takeoff moment. And there was that news that came in right at 11 o'clock that really galvanized things and put it into another gear. That's why I constantly say watch the clock, even if you don't know what the news is, right? And sometimes it's something we know, it's on the docket, it's econ. Other times we have no idea what it is. And I had a lot of people asking yesterday, what's causing this? Don't get too hung up on the why. I mean, it's nice to know the why, but if you don't have an answer, just continue to look for ways to validate it so you can participate in it, right? We need conviction to take the trade. That conviction doesn't have to be based on understanding why it's doing this. We just need to know that it's going to continue to do it so we can hop in and participate. All right, the volume is within the average, sitting at around 215. Speaking of volume, the S&P, the SPX Options Volume yesterday, I heard was elevated. We had power issues yesterday afternoon and last night, so I didn't get to look. Let's look real quick and see if they have already wiped it out or not. Yeah, 3.7 million contracts. Average daily options volume tends to be around 40 million for, like all of the market. And we were close to 4 million just in the SPX. Yeah, it's a little hot. It's not that bad. That SPY, on the other hand, 11 million. Add the 4 from the SPX, you're talking about 15 million in a market that normally has around 40 million. Choke on that for a moment, because if we add VIX to that, you're talking about nearly half of all the average options volume being taken up in the S&P. So if you ever wonder why we benchmark things to the S&P or why we continue to use the S&P for just about everything, gauging where we're at in the market, gauging flow and sentiment and structure, and SPY is the market. The S&P is the market. I mean, you can look at the Dow and the Russell and the NASDAQ. They have their purpose. But, Apple is SPY and SPY is Apple. All right, so this morning we're basically flat. We've done nothing all night long, which implies there is a lot of room to do something. Usually the sentiment is if you have a very narrow IB, initial balance, between where you open in the first 1 hour, if it's really narrow, then there's work that needs to be done for the day that has not yet been done. We've got an ADR of 2.6 and a market maker move of 1%. So just putting those two together, you're looking at 3.75. We'll do a little fudging on the numbers. We could move 3.75% today, and it would be normal. It wouldn't even be out of line. The yellow line on the top side here is only marking out the ADR. It hasn't added in the market maker move. All right, so if we add the market maker move, that gets us out to 38.20, just beyond the COG at 38.11. We want to do the same thing to the downside. What is up with Thinkorswim today? Glitchy little bugger. And that gets us down to 35.45. We have an MDP. We have a missed daily pivot. We're completely past it. Didn't touch it. Didn't get anywhere near it. That is a fully formed strategy. Markets touch that daily pivot point more than 80% of the time. So when they don't touch it, it kind of stands out. I seen talking yesterday after the market was done, and somebody said, well, nobody's going to be buying today because of how far we moved yesterday. And I want to put that notion to rest that the buying that goes on in the marketplace is algo driven. The algos don't have sentiment. They don't think about it. They don't care. They don't feel it. And the VC funds, the volatility control funds, they will buy when the program tells them to buy. When volatility drops below a certain level, they don't have a choice. They have to go out and allocate millions of dollars into the marketplace to start buying. I said millions, but it's billions. So the VC funds alone would be buying if the volatility dropped too low. Then the algos would start buying if we were outside of the expected move, meaning if we had actually rallied so far that we got above that line, which again would be so high, who in their right mind would buy there after having rallied so far so fast? The algos would. And the farther out we got, the more they would buy to get to delta neutral. And of course, their buying would cause us to go even higher, which again would get them offset in their delta, so they would have to buy more to get to delta neutral, and it would just continue to go higher. So this myth or concept or idea that, oh, well, we're sitting at the high of a range or a zone, or there was a lot of flow and that nobody's going to buy now, yeah, there is. A lot of people. If you want to learn more about things like that, you could Google market maker, hedge fund, or hedge, gamma hedging, and you'll find a couple of articles where they talk about how the market makers are forced to buy, especially if we escape the range of a measured move, right? An expected move for a week. So don't get caught up in that myth or logic that says, well, we've gone too far. There's no way anybody's buying here. I don't know if there's going to be any buying or not. The way I approach all of this is be prepared for it to do one of the three things that we know a market can do: hold the line and stay sideways, break to the upside and continue to go up, or reverse and go back down. We know it's going to do one of those three. You game it out, set your levels, play whatever you get. Leave the hypothesizing to somebody else. Another question was, okay, well, since we rallied off the bottom, then does that mean we're safe to go long in some swing trades? Safe isn't really a word that fits the current market environment, right? The overall backdrop is that we're in a bear market, and that bear market is not done yet. So until we rally at least halfway back up, then we can't consider even for a remote second that this bear market is done. We don't even have a secondary trend to the upside. We don't have a third label, right? It's tertiary or immediate trend. We don't even have that to the upside. We don't have trend upward yet. To even consider that we're in a secondary or an immediate trend to the upside, we would have to get higher than that right there. We would have to set a higher high. Until we get that, we don't have anything. We've got our lows and we've got our last pivot high. And anywhere in here is just a part of a range. We have to break this level before we have a higher high. And we have to have a higher high before we can even consider that we're trending to the upside. Now, that doesn't mean that you have to wait until we get above 3,800 to go long. There's the argument that says if you wait for confirmation, you'll lose less often. But you'll miss a lot of the move, right? So you'll make less money and you'll lose less often. And it's a good thing that you'll lose less often because you're making less money. So when you do lose, you haven't made as much as other people, and you're giving up those minor profits to cover the few times that you do lose. If you get in early before you get confirmation, you will lose more often. but you will also make more money when you're right. And again, it balances out. You've made more than others, but you're going to lose more often. So the trick is that when you do lose, keep the losses as small as you can. And when you do win, try to maximize those wins for everything you can get out of it. So you don't have to wait until we get back above 3,800. You do have to be prepared for the idea, however, that we won't make it back up to 3,800, let alone get past it. So sure, if you want to go long, you can certainly try. But there's one more argument about this. If that's the high of our immediate range, and this is the low of our immediate range, then we're sitting in the middle of that immediate range. And the phrase that I like is, don't diddle in the middle. If you get in here, you don't know where your stop should go. You don't know what is wrong. If it goes down this far, are you wrong? Because it could just pull back there and then continue to go up. What if it goes down this far? Are you still right? Should you still be in it? Because it could just bounce there and go up. You wouldn't know you were wrong until it got all the way down here. And the same thing if you try to short it from here. It could continue to go up a little bit more. Would you need to get out of that trade? What if it continued up a little bit more? Would you still need to get out of that trade? It could just reverse. So getting in the middle leaves you vulnerable because you don't quite know what your exit should be, unless you're just using a percentage-based exit, right? Like, well, it went X percent, I'm out. I mean, okay, there's certainly nothing wrong with that argument. Or you can start out in a day trade and let the day trade last and turn it into a swing trade. And as long as it doesn't breach your levels, then you're fine. I mean, that works. We are above the 4, we're above the 10, and we're under the 20. We're almost pinched between that 10 and 20. The 4 is still under the 10, so we don't have surge. The 10 is under the 20, so we don't have momentum. We don't have momentum, we don't have surge, we don't have trend, we don't have strength. We have nothing. Since we are above the 10 and we're basically resting on the 10 at this moment, that 10 could begin to provide a little bit of support, except if we've already crisscrossed it a few times and it's a sideways 10, we don't look for a moving average that's sideways to provide anything, and basically ignore it, especially if we've crossed through it a few times. The 4, we tagged it and bounced off of it last night, so at the moment it's a first touch play and you already missed the touch. First time we bounce, the second time we break. So it's very likely if we come back down and retest that 4, we're going to break back through it. Otherwise, for the upside play, you got to keep in mind that the 20-period moving average is up there and it's at 37.32. So there's the 4 EMA, there's the 10, it's where we're resting at right now, and then we got the 20. But the 20 is all the way up here at the first ADR half. We are interacting with that weekly pivot point. When we're above the weekly pivot points, we're bullish in the broader sense of the concept. Right? It's not like we're going to immediately go long because we're above the weekly pivot, but our stance would be let's look for longs because we're above the weekly pivot. We were above it. We've already given it back up. Now we're back down. keep in mind that we could just maintain the range today. After such an explosive move yesterday, we very well could just hold the line. And that's really all the market needs to do today. It doesn't have to advance, and it doesn't have to decline. If it maintains the range, everybody's going to see it as a great week. Like, oh, wow, this was great. It had a great rally yesterday, and we kept it, and we didn't crash and burn. Yay for us. So it's a very low benchmark. All they have to do is keep it above 3660. And it's very likely if we break 3660, we're going to begin to retest all of those levels from yesterday. One of them that you're really going to want to focus on is the start of the PPI announcement, which happens to be right where our daily pivot point is. So if we come down to the daily pivot point, that would be like a first touch play. And you might want to use the pivot point strategy, R1, S1. You could use like Person's pivots. He's got a pretty decent strategy. If we break the daily pivot point, focus on the Globex low of yesterday, that'd be 35.82. That would also be the full ADR at that point to the downside. Then beyond that, we would focus on the cash open of yesterday and then the low of yesterday, 3,500. I had on a 5-cent butterfly way down there yesterday. I bought it for 5 cents. Obviously, it didn't work. But, you know, a 5-cent butterfly, I mean, what's the worst that's going to happen? You're going to lose $5 and commissions. It didn't work. But, you know, for a scratch lottery ticket, yeah. All right, so that's the retracement talk. A continuation. We would focus on getting back above the weekly pivot point, getting through yesterday's high at 36.97. We're going to call that 3,700. We got the COG line at 37.11. ADR half, 37.30. We got a retracement at 37.50. ADR full at 37.78. And then the previous week's high at another COG line, basically 38.11 or 38.20. I find it difficult to believe that we would get another day like yesterday, right? Part of the short covering rally and options getting closed out. We could. I don't see that as the primary base case argument. My base case argument is that we're going to retrace yesterday's level by about 50% at least, and then stick that going into the close. So the thing about really big candles, you want to measure them and kind of keep track of the 50% mark. $3,600. It would not surprise me if that becomes our destination if we break this pivot, this Globex low. That's what I would focus on, right? But it's just going from level to level to level. Run it through the day. Interesting enough, that reversal yesterday happened in a shallow area with no pivot points. So if we turn on the moving averages again, it's possible that we bounced off of a moving average and took a rejection. That was also yesterday's ADR. It was the top of the ADR yesterday. I remember I posted some pictures yesterday on ADR and then had to spend a good 20 minutes explaining to people what the ADR was. So we did make it a full ADR move, and that was all we got, which was kind of interesting. There is some volume support underneath this around that 3640, and the point of control is back to that 3600, which I just mentioned is kind of my ballpark go-to since it's 50% of yesterday's move. So it's kind of nice to see that my base case argument of 50% of yesterday's candle also lines up with the point of control here. This is also showing us that if we do break above our own Globex high today, we still have a relatively shallow zone that we can work through until we get near that 3800 area. No point of control or value areas to bring forward from yesterday, so we're not going to get any assistance out of that. So what we're looking here at this watch list, this is the top 20 names, I believe, in the NASDAQ 100, which basically those top 20 names by market cap, they basically run everything. And this morning, Netflix is up, having kept the gains from yesterday and continued that move to the upside. And Comcast continuing from yesterday. But then we've got a whole lot that are flat, and we start getting into some that are negative. Qualcomm, Apple, Facebook, Tesla, Google, Microsoft, Amazon, the FANGs, basically. Now my benchmark starts at around 0.5%, and none of these to the upside meet that qualification. So we need to give them a little more time this morning before we start to consider that they are, up or down. Gold is down quite a bit, and so is energy, XLE. Also, crude is down this morning. Natural gas. Then we've got a whole lot that are flat. And Bitcoin happens to be up this morning another 1.25%. So it really seems like the market's waiting on something still. And yet there's nothing really big on the docket except for maintaining the line, right? Let me sign in, you freaking thing. Aha. KWeb is up. Let's check that. I say let's check it because if it hasn't had any volume, it'll still be reading what could have happened after hours. And we can see, looking at KWeb this morning, I mean, that doesn't look like it's up to me by 1%. Could be I'm missing it. Guess I'm missing it. All right. So the reason that KWeb is something worth looking at, it's basically China technology. Uranium. Nothing in the chip names at all. With Bitcoin being up this morning, we want to see what else might be up. MSTR. Wow. Check that out. This is a good proxy for Bitcoin, right? So, I mean, it's got an ask of 224. That would imply that it's up, right? But there's no volume here. There's nothing really there yet. I would have to continue to watch that one through the morning before we consider there's something to it. Let's see what else we got. I don't like any of the rest of them. All right. Under electric vehicles, it's a lot of those smaller ones. Canoe, Renault. So your bigger, more normal names, Tesla, XPEV, Li Auto, not so much. Right, they're in the negatives. Now, NIO's up slightly, but my benchmark is 0.5%, so we would need it at least that far before we'd start to consider that it's up. Communications was doing really good yesterday, and it wouldn't hurt to see if we can get a follow-through in there. Comcast, Netflix, T-Mobile. Now that's a nice reversal on T-Mobile. That one might be worth taking a look at for some follow-through today. Oh, see, it doesn't even look the same here. Never mind. Not what I was looking for. All right, so Citi just got kicked in the face. Morgan Stanley, either by sympathy or just, the expectation coming in was that banks weren't going to kick off this earnings season in a healthy way. I was reading that on, it was either Morning Joe or Morning Brew, Morning Brew, or it was in Bloomberg. So that's not my input on that. I didn't really have an opinion on the banks, just because that reserve capital that they hang on to they can screw around with that a little bit. So I never really have much of an opinion on banks and their earnings, but the expectation was that they were going to miss, and BlackRock's had a lot of negativity this year. I mean, just wow, a lot of negativity. So the fact that they came through earnings yesterday, okay, I kind of thought it was just a part of the everything was running situation. Now, as I've talked about before, I lumped the top three here: J.P. Morgan, Bank of America, and Wells Fargo. I put these three in a group, and then Citi, Goldman, and Morgan Stanley. I put those three in a group. I recently knocked Berkshire off of the list and BlackRock off of the list, and that just gives me my three across the top here and my three across the bottom, and they tie in with the XLF. Now, this is a broad brush, right, looking at the XLF, and if you want more bank, like regional banks, KRE is a better choice. The thing is, trading wise, I don't trade any of these names. So I like using KRE to monitor, say, financial sector. But I hate it from the perspective that I don't trade any of these. So I have an option strategy that I use for, doesn't necessarily have to be end of week, but for situations where we've had a really, really big up day. Here's an example. A really big up day and the expectation that it's not going to continue. And you're basically putting on the trade, and you can put it on anywhere, mid candle, near the low of the candle, wherever you want. I don't like putting it on at the high of the candle or higher because you usually can't get any premium for it. But putting on a trade that says, okay, you basically took an accelerated shot to the upside, and now you're done, at least for the end of the week, and you're not going to challenge my position, and you're going to very likely continue to fade. And you put the trade on. We've had that, and the bigger the move, the better. And when things like Amazon and Google were crazy, crazy expensive, it was even better still. So they're not as expensive now. You can't get the same kind of pricing that we were getting before. But if you look at something like Amazon, and say you open up your spread using the 75% benchmark with the expectation that it's going to decline and not get back above that level by the end of the week, it just makes for a nice short-term trade. If they don't open gapped down and they open near the high of the range, you could use that. I mean, there's nothing wrong with that at all, right? But usually you get that kind of gap down move after the initial big day. And so you can't end up, or you can't use those options without getting really nasty premium value. So the way to approach that is to find the biggest movers from yesterday and use them as your starting point. So I was talking with somebody yesterday about trades to take, finding new opportunities, or having something. And there's still a lot of great trades on the table if you're looking for opportunities. So for some swing trades, Tesla fits. Now first, let me show you what we're looking for, or what the expectation is, right? And then we'll look at names that haven't made that move yet. So what we're looking for, what outcome we're looking for, is things that look like that when we're done, right? That's not where we want to start the trade. That's where we want the trade to end up. Something that looks like it did this. So what we don't want is things like Meta, PayPal, Roku. These are what we don't want. They've already made the move. Nvidia has not yet completed that move. Tesla, Apple, Google, Microsoft. These names have not made that big move yet. They have not had the destruction that everything else has had, right? And those are the names that you want to focus on. At the start of the year, I had some of my Google levels showing during a morning briefing, and it was, it had a stock split since then, so the numbers are different, but area-wise, my targets were down here. And that was back when we were still sitting way up here. And everybody said, no, that's too far away. You're basing that on some unrealistic price action. Look at Facebook and tell me it's unrealistic. Or Roku or Baba. Go down the list, right? There's really great examples of things that's taken magnificent beatdowns. So there are still a lot of swing opportunities. Excuse me, I hope I didn't blow anybody's ears out there. Whoa. All right. Tesla has a lot of room left to go. This thing has not even really gotten started yet, right? If you look at everything else out there, this is just getting ready to get started. On your break to the downside, and that's a monthly level to 216. on your break to the downside, the 200 would be your first target. Now, I've got two purple lines down there for a reason. I've got the EMA and I've got the SMA. To me, each one of them is a target, both of them. I would like it if it would run up and bump its head on that white line. That'd be the 4-period weekly moving average. That would be the best entry you could ever hope for. I doubt we're going to get that, right? You rarely ever get the beautiful entry that you want. But on the daily, it did come up and bump its head on that 4-period moving average. So you got your monthly level, 216. Breaking and closing below 216 on the week, having a weekly close below 216 would be a great place to take a new short. And these are not going to be straight shot plays, right? There's going to be some dragging of feet, there's earnings, there's going to be upside moves, but you're talking about a longer duration swing trade and keeping the trade as long as it doesn't break through critical upside levels. So, for an example, we wouldn't want to see a higher high, and that's a long ways off, right? So if you're using things that you can't defend, if you went short and it went that far against you, you're going to be feeling some serious pain, right? I mean, that would be just a little too much. So kind of cut it down into a daily time frame, or trade things that you can defend. By defense, I mean if you go out and you buy puts here and at this location and it continues to go up, well, you can defend a put and just sell puts against it. It's simple enough. That will allow you to maintain that short position even if we continue to rally. And that shouldn't be new, because that's what we were doing the whole time when we were rallying for the last 2 years when we came out of COVID. Right? We stayed perpetually short through this whole move and made money on it. So you can stay perpetually short in an upside move and not get your face ripped off money-wise. You can make plenty of money. You're still holding shorts, so if we do dump, your shorts make the money. But you're continuing to defend it and make money in the upside move. All right, so we've got Tesla, Microsoft, Apple, Nvidia, Google. They're basically the monsters of tech. But as a sector, semiconductors are still pretty strong in relation to other sectors out there, right? If you look at what's been going on, and something that stands out on sectors is XLU. Now, there's been some really smart people who have been talking about XLU lately, right? And I mean, there's like 4 different trade groups out there, and really big name players that's been talking about this. This is supposed to be a boring, slow, rarely moves big, kind of a low beta product. And the move that it made has been just crazy. Now, part of this is redemptions. I mean, there's a whole lot of different reasons to it, but the one that I focus on is redemptions, that dreaded R word. If things pick up in the redemption department, this very likely is going to continue that drive to the downside. And one of the benchmarks that you could focus on would be 57, right? Aiming for around $57 as your target. And you can see, if you run fib the way that I do, that was the structure that we had measured, and what it owed us was a move to the 1, 2, 3, 6. That's all that it owed, and that's all that we got. and that is the end of the move. So technically speaking, since it did get to my target, I could move the fib at this point. And if we did that, we tagged 50% of the move this week. That's at $60. Basically, give it a couple pennies either way. We came up and we tangled into both moving averages. It's that 200 period, 200 weekly moving average. So a good signal for next week would be that we open next week gapped down and we make another run towards 60. Break 60, then we're headed to 51, 50, right around in there. Nice play. So it's not just semiconductors that you can play. There's a lot of other sectors, and finance now, especially with this bad earnings, finance is still on the table as a sector to take a beat down. XLF, I showed you what Facebook looks like, and Roku and PayPal, that significant beat down all the way, 75% haircut. Well, I mean, look how healthy finance looks compared to that. It almost looks like Apple or Tesla or Microsoft. It's still strong, relatively speaking, compared to all those others. It has a lot of room to fall. This would be a name on my list for a short opportunity. And finance is cheap, right? You start getting into things like Tesla and Amazon, those options can get crazy expensive. Compared to those, finance is cheap. So if you're in a smaller account, XLF is a great way to go. It's not sexy and glamorous and everybody's not talking about it, and it's not going to have the same beta. It's not going to move as much. But with options, it's not always about how far it moves anyways. So just kind of keep that in mind. There are plenty of opportunities. We're still in sell the rip mode, not buy the dip mode, right? So all these rallies are new opportunities to go short. It's what I got, everybody. Duration, I mean, take your pick, right? Trade level to level. The front end of the options curve is trash. So even if you're only going to hold it a week, you'd probably want to use 2 months out at least, right? We know that they're going to raise rates in November and December of at least 75 basis points. And they're talking about February for 75, but maybe 100, maybe 50. What they're not talking about is a pivot. So you can go all the way out to February and you'd still be looking for short opportunities, right? We're talking about swing trades, not, well, I'll hold it for 5 days and get out again. If you're going to want to short XLF or the chip names or Tesla or Google or Amazon, you better be prepared to hold on to it for a while. Absolutely, and that's the best part. If you come up in the front and you're trading like November options, you don't have any room to defend it. But if you use January's options or March, then you've got room in front of it to defend it. And that way, if your puts are losing, you make money on your long puts, or on your short puts. Go in and sell puts on it, make money on that. And that way you're making money on both sides of the fence, right? So give your options enough room that they can be defended. And just keep your eye on the curve, right? The options curve. So you got the implied volatility here on the side. And of course we just, scratch that front one out. We're not even focused on that one. One thing that'll make it easier if you're not used to looking at this is use your filter and turn off the regular. Use weeklies or quarterlies. Let's use quarterlies. Nope. Regulars. There we go. So this is only monthly expirations. It gets rid of those weeklies. And without those weeklies in the way, now you can see the curve better. It's supposed to go from like this. And when you start seeing it the other way around, it kind of gives you an idea of where you want to go. So especially if you're selling, you don't want to be selling in the front end, not for swing trades. You definitely don't want to sell the low stuff. That's 65 right there, 65, 66, 69. You want to come out, say March, I guess that's June, April or May, June, right around in here. Kind of keep your eye on the curve. Earnings will stand out because they'll have like a higher implied volatility value. So stay away from the front end. Look at your pricing. Probably February and March is going to be a good spot. Look at the bid-ask spread. Look at the players. See if there's already institutions that are in there getting work done. We're talking about trading in the most popular names on the marketplace, right? Apple, Amazon, Microsoft, Google. They're really, really popular names, and the institutional positions should stand out really easy. If they don't, move to a different name, right, or a different expiration. So those Januaries right there, those stand out really big. And this one right there, right there. You don't have to trade what you find, right? That's not telling you, okay, well, I'm going to go in and use those strikes. But it is showing you that you're not alone, that you're not the only player in the game out there. Also, the higher implied volatility, or at least the open interest in those areas, might give you a tighter bid-ask spread, right? And if you're going that far out, the bid-ask spread is not that sexy to begin with, right? 35 cents. Look for any kind of arbitrage. I hate to say that because arbitrage in the current market, I mean, the machines are so much better at doing that than us. And when anything gets out of line, it just gets beat right back into place. So you're very unlikely to find any significant arbitrage that you could play. But if you're looking at March, make sure you look at February and April. If you're looking at April, then make sure you look at March and June, right? Always look one series up, one series down. If you're looking at the 220, take the opportunity to look at the 220 in the next one. Look at one strike above, one strike below. Don't just use some delta value that says, well, my strategy told me to use a 42 delta and I'm going to go out and get the 42 delta. Look above and below it and make sure that there's no other choices as good as the one that you're about to get. A lot of times there won't be anything to see. There's no better choice, but at least you looked. If you didn't look, you can just get yourself tangled into a trade that sucks because you missed something that could have been better. These are duration trades, so if they start to lose, you're not going to want to close them down. You're going to want to defend them. So just kind of keep that in mind. Defending the trade is going to save you from getting into a trade, starting to take pain, and then puking the position out. I really like Tesla for how strong it has been and the fact that it really hasn't even begun to get the beat down yet. It's still above the 200s on the weekly. And the darling of Wall Street, Apple, this thing isn't even back down to its June lows yet. I mean, talking about something that's got room to take a beating, this thing has plenty of room. But it's going to be defended because everybody owns this. It's in every pension fund. It's in every 401k. I mean, this is the most beloved product that exists. And every time it goes lower, everybody says, oh, I've never had an opportunity to buy it at this price. I'm going to buy this. This is cheap. This is great. So, there's the opportunity buyers. But at some point, capitulation is going to come. Everybody's going to start puking all these positions up, and we're going to get that lower level. So Apple, Tesla, those two, lots of room left. Microsoft, okay, this one's already started the move. It's below that June low, and it's threatening the 200 period moving average. So this is kind of an example of what I'm talking about. Look at how it hasn't been a straight shot. It has not. If you were short in this, you've had to hang on when it went sideways and challenged you for a week or two, right? After this kiss of death here, I've heard it called. That's not my phrase, but it fits. Ran up into the 50 period weekly moving average, gapped down with conviction, and then broke through every single level. And then it gapped down again. I mean, that's just super crazy bearish. Broke the lows and kept right on going. But we had that rebound down here before it flipped over and kept going. So it hasn't been, painless. There's still plenty of room here. I think it's going to break that 200 and keep on going. But this would be a good example of what we're looking for in Microsoft or in Apple and in Tesla. NVIDIA is another example of what it's going to look like. Right? That hasn't been a straight shot either. But it is now below the 200s. There's nothing else down there except these gap fills. And they are the target. You can see I haven't come in to clean up my chart yet because this gap is filled. So it's actually needs to be adjusted. But those are the targets. There's plenty of examples of what we're looking for. And there are plenty of names left. Make sure if you don't like the names that I've thrown out and you want to find some of your own names, that's great. Just check the liquidity. If the options aren't liquid enough, this isn't going to work for you, right? Because you have to be able to defend a level, which means you have to be able to get in and out of things. You need the liquidity, I guess is what it comes down to. So if it's not as popular, say you're trading a name that does have weeklies, but they're not really great, they're not really liquid, you may have to use a spread on those, and that is the defense. Just having the spread, it caps your loss. It's a much smaller position or smaller risk, and you just do it tasty trade style and say, well, if it's a loser, I'm just going to let it lose and walk away. I don't really like that style, but I mean, you can't argue with its effectiveness, especially in a low liquidity environment. Everybody be careful. Have a good one. Remember, today's base case argument is that we're going to maintain the range. That's all the market needs to do today, is just hold this range. When we set a high like this, and then we come off of that high, and we're coming into the open, watch for a run up to bump its head there and then dump. We've seen that play before, right? It's a rerun. We know that. So watch that. I'm not saying we're going to reverse if we get there. The way that I like to say it is, if we were going to reverse, that would be where I would expect it to happen, right? So watch for that. And the same thing the other way around. If we come into the open and we start making an exaggerated quick move to the downside, look for it to bounce off of that low and then rebound and run up. Because if we're going to stay range bound today, this very well could be our range. Which means when we get down there, we want to look for a reversal and run it back up. And then when we get up here, we want to look for the reversal and run it back down.